Over the last 3 years, we've seen home prices in the United States increase dramatically. What this means is that a lot of people now have higher amounts of home equity than before. As home prices increase and mortgages are paid down, the amount of equity each homeowner has increased. So today, we're going to talk about how to access this home equity through two different products, a home equity line of credit and a cash out refinance. And then we can discuss the pros and cons of each one and which one might be better for you. So the first thing that we're going to talk about is why you might want to access your home's equity. The first reason might be home improvement. You might have things around the home that you've wanted to renovate, but you don't want to pay cash for. So if you want to remodel your kitchen, bathroom, you have to put on a new roof, new siding, redo your floors. All of this might get expensive and you don't have the cash on hand to pay for it. So you might want to tap into your home's equity to help cover those costs. The second is debt consolidation. Now, if you have a lot of high interest rate credit card debt or even student loans, car payments, or credit card debt, you might want to consolidate this into a home equity line of credit or cash out refinance. The reason for this, the cash payments each month on those debt payments will likely be higher than if you did a home equity line of credit or cash out refinance. Now, the third reason you might want to access your home's equity is a down payment for another investment property or primary residence. We have clients who own homes who have equity, but they don't have cash on hand for the down payment on their next primary home that they're going to move into or an investment property. So they tap into their home's equity through one of those two products to buy their next home. Other reasons might include that you want to invest in an emergency fund, other investment accounts, or you might have kids going to college and want to use your home's equity to pay for that. So how do you check how much equity you have? The formula is the value of your home minus your mortgage that you owe is your home's equity. So if you have a home value of $500,000, a mortgage of $300,000, that means your home equity would be $200,000. 500 minus 300 equals 200,000. So how to increase your home's equity? The first is through appreciation in your market. As home prices increase, the value of your home will go up and the amount of equity that you have will also increase. The second way is any major improvements. This is a way to force appreciation in your home separate from what the market does. So if you renovate a kitchen or a bathroom, this will increase your home's value. And as your home's value goes up and your mortgage continues to go down, your home equity will increase. And then the third way to increase your home's equity is to pay down additional principal each month. So as you pay down your mortgage, you're increasing your home's equity because the value is staying the same, but how much you owe is going down. So the first thing we're going to look at is a home equity line of credit. A home equity line of credit is a second lien mortgage. What this means is when you get a home equity line of credit, your first mortgage that you have on your property, if you have one, stays exactly the same. You're not touching that mortgage. So if you have a 3% interest rate on a 30-year fixed rate loan that you received in 2021, getting a home equity line of credit won't change that. A home equity line of credit is similar to a credit card in that it is a revolving debt. It is interest only and it's a variable rate loan. What this means is if you take out a home equity line of credit for $100,000, one, you're not going to be charged interest right away, only when you tap into it. Meaning, if you pull a $100,000 line of credit on a home equity line of credit, you're not going to be charged interest on the $100,000 until you pull $100,000 out and put it to use. The terms on a home equity line of credit are a 10-year draw period, and during those 10 years, the payments are interest only. So on $100,000, if the interest rate is 7% and you tap into the $100,000 right away, you're paying $7,000 a year for 10 years. After the 10-year draw period, you will then pay off the home equity line of credit over a 20-year period where you will be paying back principal and interest. The second option is a cash out refinance. A cash out refinance is different than a home equity line of credit because it's not a second mortgage. It's a first mortgage that completely pays off any loan you have on the property. So let's say you have a current mortgage on your house for $300,000. Your house is worth $800,000, but you're going to take out a cash out refinance for $500,000. What's going to happen is you're going to be given a new loan for $500,000. You're going to take the $500,000 and pay off the $300,000 you owe. After closing costs, you're probably going to walk away with about $190,000. In this case, you now have a brand new first mortgage for $500,000 versus a home equity line of credit. You keep your first mortgage in place and have a second mortgage payment completely separate. Interest rates on a cash out refinance are typically lower than a home equity line of credit, but higher than a rate and term refinance. Rates on a cash out refinance are usually fixed for a 30-year period, but you can also do a 15-year term. Unlike a home equity line of credit where interest rates can increase as the federal funds rate increases and so does the prime rate, cash out refinances, you're locked into your payment. Now, what are the max loan to values that you could take out on a home equity line of credit and a cash out refinance? For owner occupied properties, meaning properties that you live in, the maximum loan to value for a home equity line of credit is 90%. There are a couple lenders that'll go up to 95%, but they're tough to come by. For investment properties, the max loan to value is 70%. You're gonna be best suited finding a local credit union or local bank to do a home equity line of credit on your investment property. Now for cash out refinances, the maximum loan to value on an owner occupied single family is 80%. So if you live in your house, you could take out 80% of its value. On a $500K home, you could take out a loan for $400,000. For an owner occupied multifamily, that number is 75%. For an investment property, if it's a single family, you could pull out 75% of the mortgage. If it's a multifamily, you could pull out 70% of the value. For a multifamily, you could pull out 70% of the appraised value of your home. Qualifying for a home equity line of credit and a cash out refinance are different. It's actually easier to qualify for a cash out refinance. For home equity lines of credit, the credit score minimums are typically higher. Most banks have a minimum credit score between 680 and 700 to qualify. You can qualify for a cash out refinance with a minimum credit score of 580. As your credit score increases, your interest rate will go down. For both cash out refinances and home equity lines of credit, banks, credit unions, and mortgage brokers are going to look at your debt to income ratio to make sure that you could qualify for both loans. Are the proceeds that you receive from a home equity line of credit or cash out refinance taxable? The answer is no. Home equity in general is a type of profit that you only realize when you sell. That is why many investment professionals prefer to do a cash out refinance to tap into their home's equity versus selling. If they were to sell their home, they'd have to pay capital gains tax. If they do a cash out refinance, that money they receive tax-free and can redeploy into other investments. For a home equity line of credit, the interest is deductible if used for home improvements. So if you're taking the HELOC out and using it to improve your home, you could deduct that interest on your tax returns. For a cash out refinance, it is treated like a regular first mortgage. You can deduct the interest paid on the first $750,000 of the mortgage. I believe that these products are both great ways for real estate investors and homeowners to tap into their home's equity and redeploy that cash into opportunities that are best suited for them. For example, I personally have done the BRRRR method where you buy, rehab, rent out, refinance, and then repeat the process on a few investment properties. Tapping into your home's equity allows you to pull money out of one property and go buy another. In my personal scenario, I've used both home equity lines of credit and cash out refinances. In a rising interest rate environment, home equity lines of credit become more popular because people don't want to refinance their first mortgage that they received at 3 or 4% interest rates. As interest rates go back down, cash out refinances become more popular because clients are going to want to refinance the properties they have interest rates at 6 or 7% back down to 4 or 5%. Right now, we are seeing a lot of clients opt for home equity lines of credit. Both options are great, and you're best suited talking to a mortgage professional to find out which one is best suited for you.